Afternoon. Let's continue our discussion on profits and gains from business and profession. So, if you remember last class, we were discussing about some fundamentals, which includes what business is according to Income Tax Act, and as you are aware, Income Tax Act Section 20, Section 2, subsection 13 is the defining section that tells us what business is. So, according to the section 2, subsection 13, the term business includes trade, commerce, manufacture, and adventure. Now, the first three terms are relatively easy to understand for us, but adventure is something which you have to get familiar with. So, adventure is an isolated transaction of business that does not occur repetitively, but it is in the form of trade, commerce, or manufacture. So, it's an isolated transaction that does not occur quite often, but that's quite difficult to identify, right? So, over the period of time, when we do various numerical questions, you will be in a position to understand what exactly this adventure means. So when we say income from business, income originating from trade, commerce, manufacture, and adventure is not the only source of business income. Of course, income tax also has prescribed certain list of transactions under section 28, under section 28, that also tells us what business income is. So this section 28 is extremely important from the viewpoint of understanding what exactly business income is. So apart from trade, commerce, manufacture, and adventure, these are the list of other transactions that are also classified as business incomes. Now, what are this list of transactions? Something which we have gone through in the previous class. So there are two more transactions which are left out, which will come under the ambit of section 28. The seventh one being is speculative transactions or speculative business. Now, speculative business is a very interesting transaction which generally happens in financial markets, specifically in share markets and commodities market. So, in speculative transactions, trading happens uh, in in the form of cash settlement. Now, trading that happens in the form of cash settlement is quite tricky uh, to understand. So, therefore, you have to pay attention, right? So speculative transaction or speculative business is selling something which you actually don't have, trading in a particular commodity which actually not there, which is actually not present. So trading in commodities which actually do not exist is called speculative business, right? In share markets, you have something called as short selling, which is an example of speculative business. And derivative transactions like futures, options, forwards, swaps can also constitute some of the best examples of speculative business. So, what happens in speculative business? The buyer and seller don't actually trade in commodity and do a physical settlement, but rather they do trading on the prices of the commodities. So the trading happens not on the actual commodities, but on the prices of the commodities. So this is how your speculative transactions work, right? Let me quickly check the MS Teams because I see a lot of people waiting in the lobby for no reason. Okay, so what are speculative what is speculative business? Basically, these are transactions in which trading does not happens in actual goods, actual commodities, but the trading happens on the price of the commodities. The trading happens on the value of the commodities. So you need not have these commodities to transact, but the entire transaction happens on the price of this commodities, right? So examples being your future contract, forward contracts, derivatives, short selling. So these kind of transactions is also categorized as income from business. And finally, you have Keyman Insurance compensation. Now, every company for that matter, especially if they are big corporates, big enterprises, right? For that matter, even small companies, the growth, the performance, and the success of the company depends on the quality and the ability of the leadership. So, a committed leader with his expertise, with his diligence, with his experience can take the company in a different direction and make the company reach greater heights, make the company stand apart in the competition, right? When we think about any big company, right, we always associate that organization with its important leader. So when we say Apple, there is somebody who represents Apple in the form of leadership. So when we say Infosys, who's the force behind Infosys. So when we say Mahindra and Mahindra, there is a leader behind the company's success. So whether it is Steve Jobs, whether it is Narayan Murthy, whether it is Anand Mahindra, all these leaders are very important, right? So what happens is, in case if these leaders depart, in case if they die, the organization may suffer a serious setback, right? When the Steve Jobs death news became public, there was an immediate response in the stock markets. The shares of Apple fell. So why did investors started selling Apple share, and why did the price go down? For a simple reason that investors believe that he was the instrumental personality behind the progress and the success of Apple, and we don't know what will come in the future. So therefore, it is not just the investors who have close sentiments towards the leadership. Practically speaking, a business may also take a hit and suffer a huge amount of losses in the absence of that leader. So as a result of this, life insurance companies offers a product called Keyman Insurance. Now, what happens in a normal life insurance is if the person dies, the compensation is given to the dependents or the family members or the nominees. But in case of Keyman Insurance can be taken by a business in the name of the most important leader, which the business perceives to be. So let's say Mahindra and Mahindra can take insurance in the name of Anand Mahindra. So what happens in case if something happens to him, right? In case if something happens to this business leader, in case if he dies, the organization may suffer setback. So the compensation money in case of Keyman insurance policy is not given to the family members or the dependents of that person, but rather the money is given to the business. So if Mr. X dies, who's the CEO of, let's say, ABC company, upon his death under Keyman insurance scheme, the money will be given to the business. So what income tax department is saying, in case if you receive compensation under Keyman insurance policy, that compensation is also classified as income from business. So these two sections, section 2 subsection 13 and section 28, gives us by and large a comprehensive list of transactions that by and large we can close our eyes and say that yes, this is income from business. So therefore it is very important for you to understand these two sections, because these two sections tells us what constitutes income from business. The way certain criteria will tell us what constitutes income from salary, the way certain criteria tells us what constitutes income from house property. Similarly, if any transaction has to be classified as a business income, it has to come under the purview of either section 2 subsection 13 or section 28. So that's the reason these two sections are very basics and very important for us to classify any income as a business income. Now, I want to share an income statement or a profit and loss account with you guys, because this entire chapter, income from business or profits and gains from business and profession, revolves around profit and loss account. So you please go through closely, take some time, go through this profit and loss account and tell me if there is any transaction according to you that should not have been recorded in this profit and loss account. So do you think any transaction which is recorded in this P&L account, do you feel that any of the transaction which is there in this profit and loss account should not have come here, or is invalid, or is totally unacceptable? So please go through this and tell me if there is any transaction which you feel should actually not come here. Roll number 68 from A section.
Yes, sir.
What do you think? Which transaction seems to be incorrect or should not come in profit and loss account in the list what you see?
Sir, I'm not able to list. I'm able to see your video.
No, it's not the video, it's a screen. I've shared profit and loss account with you.
I'm actually able to view your video only.
You're not able to view my video.
No, no, I'm able to see your video.
Then
Not
what is it you're not able to see? You're not able
the
to see the
list.
profit and loss account what I've shared?
The list you're saying.
No, I've shared a profit and loss account on the screen.
No, sir, I'm not able to see.
Okay.
Screen your video is coming.
Okay, I see. Okay. So the question that needs to be answered is, what is our job in this chapter? What are we going to do? Because logically speaking, a businessman already prepares profit and loss account. He has already shown what is the profit he has earned at the end of the profit and loss account. So the concept is simple. When we say income tax, it is a tax which you have to pay on your earnings. Then what is our role here? What are we going to do? When profit is already calculated, when profit is already given in profit and loss account, then what are we supposed to do? The answer to this question is the profit and loss account prepared by the sole proprietor. Let me remind you once again that we are studying income tax of individuals. We are not studying income tax of companies, partnership firm, local authority, association of person, body of individuals. We are studying only income tax of individuals. So whatever we study is from the perspective of an individual. So when we say individual run business, it is nothing but sole proprietorship. So when profit and loss account is already there, when net profit is already there, the job is simple: calculate the tax, pay the tax. But that's not as simple as it looks. The profit and loss account prepared by the sole proprietor will have a lot of flaws, a lot of differences. The reason for differences and flaws. Reason number one: there are incompatibility issues between accounting laws and income tax laws. What accounting laws advocate, income tax laws totally are against it. Accounting laws advocate that you can create reserves, you can create provisions to meet your unanticipated and anticipated losses in the future. To meet your future requirements, you can create reserves, you can create provisions. But what income tax laws says are totally opposite. Income tax law says the more reserves and the more provisions you create, it will reduce your net profit and ultimately you end up paying no tax or very less tax. So income tax department says we don't allow you to charge reserves provisions, whereas accounting laws permits the organization to do this. Second, depreciation. Who decides the rate of depreciation? In case of companies, companies can follow the rate of depreciation as prescribed in Companies Act 2013. But when they are filing income tax return, they can't use that because I said there's incompatibility. And therefore, income tax has its own depreciation laws. Income tax law has its own rate of depreciation. Again, incompatibility arises. Third reason why we don't consider the profit in the profit and loss account is the assessee would have recorded or the sole proprietor would have recorded a lot of transactions which are not at all related to business only. We quite often see sole proprietors recording non-business transaction, non-business incomes, non-business expenses. A lot of personal expenses are also being recorded. So income tax department says, do not record all this. So there is a procedure which income tax department has given for identifying income from business. So what we have to do is we have to follow that procedure, look at the profit and loss account and prepare a reconciliation statement by calculating the right profit as per Income Tax Act. On that profit, the assessee should pay tax. So tax is not payable on the net profit given in P&L account, but the tax is payable on the profit which is computed as per the provisions of Income Tax Act. Now, generally, you will see two kind of trends in balance in the profit and loss account. The first one being that a lot of sole proprietors, a lot of businessmen show unwanted, unnecessary expenses, non-business expenses, personal expenses are being added in profit and loss account. And why do they do this? Obviously, to reduce the profit. If I ask you, tell me a strategy to reduce the net profit, what are the two strategies? Strategy number one, increase the expenses. Strategy number two, reduce the profit. Increase the debits, decrease the credits. Strategy number one, simple as that, right? So showing less profits makes sense because every individual wants to either avoid tax or end up paying very less tax. So it makes sense. But why would somebody show higher profits? Let's say my profit is 7,50,000, but I have inflated it to 15 lakhs. People reducing profit by doing all sorts of manipulation makes sense because they don't want to pay tax or either they want to pay less tax. But why would somebody show more profits and pay more taxes? What sense does it make? The answer is if you show more profits, it's very easy to attract investors. This is from the viewpoint of company in which shareholders are the investors. But for a sole proprietor, higher profits, by showing higher profits, it's very easy to borrow loans. If you want to borrow a loan from a bank will see your profitability, right? The higher the profits, easy to get the loan. So there are people who do this also. By and large, people show lesser profits to avoid tax, but there are people who show more profits also to take advantage of getting ease of loans, right? To get loans easily without any hurdles. So therefore, what income tax department is saying, neither you show less profit nor you show higher profits. Show us the right picture. In case if you're not able to show us the right picture, then obviously the provisions are there which needs to be followed and we have to prepare a reconciliated statement by identifying the right profits. So your job as a student throughout this chapter is very simple. You will be given profit and loss account. First, you have to apply your common sense, which is not common, and figure out what are the transactions that are related to business and which are not related to business. Right now, I'm showing this profit and loss account to you. Some of you saying you're not able to view it. So God knows whether you're saying truth or lies. And I see a lot of students living in between coming in. So I don't allow all those things because I told you that by 11:03 by 3 minutes, I mean by 3 minutes is the buffer time you're given to log in. But some students are getting disconnected again, they're coming back. So the attendance mechanism, which I mentioned you again, let me repeat it. Only if you have attended the class for a duration of 50 minutes, your attendance is taken into consideration. Otherwise, attending classes, just switching on the online class and being there is of no use, right? So roll number 73, are you there from A section?
Yes, sir.
Can you see the profit and loss account on your screen?
Yes, sir.
From the debit side, can you identify at least two expenses which you feel is not at all related to the business?
Drawings, sir. Drawings and donation.
Very good. Drawings is a personal expense and donation is a non-business expense. Donation is an act of charity which you're doing for your own good, because spiritually, if you donate money, I mean, there are beliefs, right? Indian society, different cultures have different beliefs, but it has nothing to do with business. So very good. You have identified two non-business expenses. One is donations and the other one is drawings. Good. Anybody else who feel that there are certain expenses which are either personal or they are not related to business from the debit side? Apart from donation and drawings.
Sir, household expenses.
Very good. Name itself says, right? Imagine the sole proprietor is buying diaper for his children and is recording that as household expenses. He's buying grocery and putting it as household expense. So absolutely, this household expense has nothing to do with business at all. It's a personal expense which is being recorded. So why it is being recorded? So that the profits reduces and this guy ends up paying lesser tax. So that is what you guys have to do as a student. Your job is to first use your common sense, identify which are the expenses which are first not related to business, which are personal expenses. For these two, you can use your mindset, you can use your logic. But there's third element also for which you have to remember the provisions of Income Tax Act. So by and large, 50% of the problem can be solved by you by using common sense. But for the remaining 50%, you have to remember the provisions. For example, I told you reserves are not allowed. What is a bad debt? A customer who has not paid the money to business is a bad debt. It's a loss, right? But what is reserve? That means still doubt is there whether the customer will pay or not. Similarly, provision. So income tax department is saying reserves and provision is not allowed, because otherwise what will happen? Every businessman will create as much as provisions and reserve with an objective of reducing the profit itself, and therefore don't pay any tax. So income tax department is saying no reserve, no provision. So what you have to do is first apply your common sense, then apply the provisions of Income Tax Act to solve this complete problem and identify the correct profits. We will be discussing the provisions of Income Tax Act one by one in detail, but I'm just telling you what is that you're supposed to do. Because if you have this common sense, I think 50% of the problem you can easily solve on your own, right? Even without going through the provisions of IT Act. Now, similarly, since you have identified a couple of personal or non-business expenses, from the credit side, let's say this guy, this balance sheet is of a, sorry, this profit and loss account is of a sole trader who is into textile manufacturing. He's a textile manufacturer. Okay, so assuming that he's a textile manufacturer, can you guys please identify which are the incomes which are not related to the business what he's doing, which are non-business incomes? In simple words, he's a textile manufacturer. So looking at the credit
Sir,
side, which are the
our
incomes you think?
expenses,
Which one?
our expenses, sir.
Expenses.
Rent from house properties.
Okay, very good. Rent from house property. You guys are aware that we have a separate head of income for rent from house property, which is income from house property. So income from house property, separate head of income is there for taxation purpose. So why has it come here? It should not have come here. That means it's trying to show more income, right? Very good. Any other income which you feel it should not come here and it's not a business income?
On shares, sir.
Very good. Income from shares. What is that shares we have here? Okay, dividend on shares. Very good. So this is where most of the students get confused, but I'm glad that you have identified this as a non-business income. Why it is non-business income? Why it is non-business income? Now one can argue, sir, I have some extra cash in my business and I have put that extra cash in shares. So what's wrong in that? The answer is there's nothing wrong in that. Technically, the principles of financial management says that cash should not be kept idle. You have studied this in financial management in your third semester, right? So technically it is nothing wrong. But what income tax department is saying, dividend on shares what you have received. Similarly, interest on government securities what you have received is an income from investing. It is not income from business. Income from business has to come either from two important sources. One, from sales. So the main business income comes from what? Sale. And what do you sell in business? You sell inventory, goods, stock in trade. So it will come from sales, or income from business will come activities related to sale. Now sale is very easy to identify. What do you mean by activities related to sale? For example, I have a shop in Chickpet, right? My cousin wants to start a new business somewhere in Ramurthy Nagar. He also wants to open one shop, garment shop. So he comes to me and he says, I want to start business in Ramurthy Nagar. Can you please introduce me to some of the wholesalers who can give me goods? So I take him to a wholesaler in Majestic and I tell him that he's my known relative. So you please give him goods. So what wholesaler does for introducing this new customer, he gives me 10,000 rupees because this guy has placed orders worth 2 lakhs. So he gives me commission worth 10,000. I'm giving you an example. This can be a brokerage. This can be a commission. Similarly, let's say I have a shop. I've done window display. So the wholesaler gives me money for displaying his goods. Commission. Right? I'm one of the top seller in the state of Karnataka. I've sold highest number of products. So a particular brand gives me incentive. So these are called activities related to sales. So what is income from business? Either it should come in the form of sales or it should come in the form of activities related to sale. Activities related to sales. Anything which does not comes under from these two point of view is not income from business. In our example, excuse me, in this profit and loss account, we have sales, which is nothing but your business income. Dividend from shares, is it coming from activities related to sales, buying and selling of goods, trade? The answer is no. This is from investment. It is taxable under the head other sources. So this is non-business income. Rent from house property, non-business income. Interest on government securities, non-business income. Profit on sale of machinery, non-business income. Because I told you, as a businessman, you have to sell current assets, stock in trade. But what is machinery? Machinery is not a current asset, it's a fixed asset. I'm using machinery in my factory to make clothes. So clothes and garments is my inventory, my current asset, whereas machinery is my fixed asset. So whenever you buy and sell machinery, if you make loss or profit, it is taxable under the head capital gains, right? So it's as simple as that. Your job is to identify non-business expenses or expenses which are not allowed by income tax department. So these are called inadmissible expenses. So what do you mean by inadmissible expenses? Inadmissible expenses are those expenses which are not related to business. Point number one. Second, they are specifically not allowed by income tax department. So this is what you're supposed to do by looking at the debit side of the profit and loss account. Your job is to identify inadmissible expenses. Once you're done with debits, you go to credit side, and from credit side, you have to identify inadmissible incomes. Now, what are inadmissible incomes? They are non-business incomes or incomes which are specifically not allowed by income tax department. So that is what you're supposed to do. The moment you see a problem like this, Your job is to identify inadmissible expenses and inadmissible income. After doing this, this is your next step. Next step is you have to prepare a reconciliated statement by showing the correct business subject to tax. Now, how do we do this? It involves three steps. Step number one, figure out what is the net profit given in the question. Your question is nothing but profit and loss account. So here in this, it is 75,000. So write down that 75,000. That's the first step. Second, identify all those transactions that reduces net profit. Now, what are the transactions that reduces net profit? The answer is if you show unwanted expenses, if you inflate expenses, it will reduce net profit. So that's the reason here it says inadmissible expenses. What are inadmissible expenses? They are not allowed by income. They are not related to business. They are not allowed by income tax department, but it is debited to profit and loss account, right? So similarly, third step is transactions that increases net profit. So what increases net profit, that has to be reduced. What decreases net profit, that has to be added. So that's the reason in step 2 we add, and in step 3 we reduce. Don't get carried away and get confused by looking at this table, because I'm showing you this table way ahead of explaining you all the concepts. So we will go step by step. We will discuss all these concepts in detail. Only then we start working on numerical problems. And understanding this chapter is extremely important. As I mentioned, this is by and large a very big chapter which constitutes majority of the questions in your question paper. Point number two, all those students who are studying corporate taxation, because some of you have electives, I think BPS will not have any electives. They have their own curriculum, but A section students, some of you are studying corporate taxation, and if you understand this chapter well, corporate taxation becomes like a cakewalk for you guys. So you have to pay attention and try understanding the concepts, for which first step is that you have to generate interest. You have to become a little more serious in understanding the concepts. Other things will automatically follow, right? So are you clear now? Roll number 68. From A section. Okay, one of the student has mentioned that we can alter our incomes and profits through a CA, and IT, as he's well aware of it. So then where is the complete transparency? That's what chartered accountants do. They'll help you to manipulate things, right? And that is where once you submit the returns, it goes for assessment. The income tax officer and the software systems used by income tax department is designed in such a way that they figure out any kind of anomalies that exist in your return, right? So this is not a foolproof system. Income tax department ERP, what they use is not 100% foolproof, but in case if income tax officer picks up your assessment, your returns manually, and he finds if there are any anomalies, he will send you a notice. If you're not able to justify and explain, then you end up paying heavy fines, and it will also invite legal prosecution, right? For which you have to go to jail also perhaps. So I don't say that it's not possible to cheat income tax department. That is what chartered accountants are there for, right? They'll tell you what are the loopholes. That's what they are for, right? So what is that you have to do is first you have to learn what are inadmissible expenses. So let's discuss inadmissible expenses in detail. We not be able to complete all the inadmissible expense because it's a big list. There are almost 14 to 15 items which you have to remember under the list of inadmissible expenses. So we won't be discussing all, but we'll be discussing some of the important ones and then probably complete the rest little later. So your job is to first look at the profit and loss account. From the debit side, identify inadmissible expenses. From the credit side, identify inadmissible incomes. So you know what are inadmissible expenses? I just mentioned inadmissible expenses are those expenses which are not related to business and not allowed by income tax department, but they are debited to profit and loss account. So let's discuss what are these inadmissible expenses one by one. The first one, this is the very important rule, and these provisions are mentioned under section 30 to 43D. So there are around 14 to 15 transactions which you guys have to remember. If you see section 30 to 43D, there are so many sections and so many transactions, but I've condensed this and made it as simple as possible so that it becomes easier for you to remember and easier for you to recollect at the time of solving the problem. So trust me, I have made this very simple and easy for you to understand. So what are inadmissible expense? What are the list of inadmissible expenses which are not allowed is what we are about to discuss. So the first in this list, in order to consider any expense as a deduction, whether an expense can be deducted or it cannot be deducted, there is a simple criteria which you guys have to remember. And that criteria is this: the expense should not be in the nature of capital receipt. Point number one, the expense should not be in the nature of capital receipt. Now, what do you mean by capital receipts? What do you understand by capital receipts? Because this capital receipt itself is such a complicated concept which you guys have to understand. So any expense is allowed provided criteria number one, it should not be a capital receipt. Criteria number two, it should not be a personal expense. Criteria number three, it should not be an outstanding expense. So this is also very important. This is where there's an incompatibility between accounting rules and income tax rules, because in income tax, in accounting rules, we do record items in profit and loss account on accrual basis. As far as the expenses accrued, you can record whether you have paid it or not, it's immaterial. For example, let's say 2020, which was the horrible year for most of the corporates and also for the employees who did not get paid. Let's say I'm one of the companies who has not paid salary from March 2020 to Jan 2021, not even ₹1 salary I have paid to my employees. But I've already deducted that salary from my P&L account. Allowed, as per accounting rules, you can do that. Because even though you have not paid it, but you have accrued it, it has become outstanding. So you can deduct from profit and loss account, permitted. But income tax department has a different rule. They are saying any expense is allowed, provided you have met it. That means you should have actually paid that expense. If you're showing outstanding expenses, it is not permitted. So therefore, you have to remember these four rules of deducting the expense. Rule number one, expense should not be a capital receipt. Rule number two, expense should not be a personal expense. Rule number three, expense should not be outstanding. Rule number four, any provision and reserve is not allowed. If you remember these 4 points, trust me, 75% of the problem you can easily solve. Only for the remaining 25 to 30% of the problem, you have to remember the other 13 points. This is the first point. The remaining 13 points will help you to solve the remaining 25 to 30% of the problem. Right now, let me quickly tell you. Let me quickly discuss the first point. The first point says any expense is allowed, provided it should not be a capital expenditure. The expense should not be a capital expenditure. It should not be a capital receipt. Now, what is a capital receipt? There are two types of receipts. You have revenue receipts and similarly you have capital receipts. This is something which you guys are familiar with because most of you have studied accounting, and you also have some of the other subjects. I'm sorry, can you repeat?
Any long-term receipt.
Any long-term receipt? Okay, so there are some important criteria that would help us to decide what is capital and what is revenue. Criteria number one, capital receipts are non-recurring in nature. They don't repeat quite often. Whereas revenue receipts, they keep recurring, right? Example, Mr. X, a sole proprietor has purchased an air conditioner for his shop. Mr. X, a sole proprietor, has purchased an air conditioner for his shop. Is this a revenue receipt or capital receipt? The answer is it's a capital receipt because you don't buy air conditioner frequently on a daily basis, right? Second criteria, the benefits of capital receipts, as your friend mentioned from A section, rule number 19, is for long term. You get to enjoy the benefits for long term. That means you buy an air conditioner, that air conditioner will last for 10 years, 15 years, depending on the usage. Whereas revenue receipts, the benefits are for short term, they get immediately exhausted, right? You're providing tea and coffee to employees who are working in your shop. Can I show this as a capital receipt? After drinking tea and coffee, it will come out very soon, right? So after drinking tea and coffee, they'll not work extra or they'll work for you forever. The benefit gets exhausted just like that. Same thing applies to salary also. So salary benefits offered to employees are revenue receipt, right? So criteria number one, non-recurring in nature. Criteria number two, long-term benefits. Criteria number three, the amount involved for revenue receipt is less to moderate, whereas the amount involved for capital receipt is generally very huge. So this is criteria number three. So whenever you're deciding whether a transaction is a capital receipt or not, apply these three principles. For example, let's say you guys are working for a company called EY, and EY for its annual day celebration, for its annual bash, has taken all of you to Leela Palace, which is a five-star deluxe hotel. And there you guys are offered free drinks, free beverages, free food, even free stay for a day. So on an average, the company has spent somewhere around 20,000 on each employee, and the entire bill has come to somewhere around 35 to 40 lakhs for celebrating annual day. What do you guys think? Is this a revenue receipt or is this a capital receipt? Apply all the three principles what I told you. Recurring nature of occurrence, long-term benefit, amount involved, and tell me whether this is a revenue receipt or a capital receipt.
Capital.
Capital receipt. So which criteria did you apply? First criteria is non-recurrence in nature. So anyways, annual day does not come every day, it comes only once in a year, so it's okay. Second, amount is also very huge, 40 lakh rupees. Third, benefits are long term. After drinking whiskey, beer, everything, the employees will become more loyal and they'll work more for you, right? And they'll work free of cost for you. So sometimes what happens is the first three criteria might be a little confusing, and that's where the fourth criteria is very important. So in case if you don't remember the first three criteria is also no problem, remember the fourth one. The fourth one is what is the accounting procedure? We record capital receipts in balance sheet. We record revenue receipts in income statement or the profit and loss account. So can I write on the debit, can I write in the balance sheet party given to employees? Have you ever come across a transaction like party given to employees in balance sheet? And if it comes in balance sheet, is it an asset or a liability? The answer is simple. This won't come in the balance sheet at all. And therefore it is a revenue expenditure. Party given to employee annual bash will come under the debit side of the profit and loss account. So fourth criteria becomes much easier for you guys. So capital receipts are those receipts which are non-recurring in nature. They give long-term benefits. The amount involved is huge, and most importantly, from the accounting perspective, they are recorded in the balance sheet. So remember the fourth criteria, which becomes quite helpful for us to classify a transaction. So I shared the P&L account with you guys. Did you come across any capital receipt on the debit side? Did you guys come across any capital receipt? Okay, so what generally sole proprietors do is smartly, whenever they buy an asset, they will record it in profit and loss account. Building purchased, 50 lakhs. So if you're recording building purchase 50 lakhs on the debit side of your profit and loss account, imagine what will happen to the gross profit. The building amount 50 lakhs will completely eat the gross profit and net profit will become zero. Don't you think it is very smart to do this? And that's what most of the proprietors do, which is inadmissible. So income tax department says clearly you can't record capital receipts in the profit and loss account. You have to record capital receipts in the balance sheet. But what you can do is you can claim depreciation. For example, if I buy a building, I can't record building in P&L account because it's totally illogical and unethical. So therefore, can I charge depreciation at least? The answer is yes, but not according to the rate of your choice, but according to the provision of section 32, which tells us how to charge depreciation. So these are the four basic rules of deciding whether an expense is admissible or inadmissible, whether an expense is allowed or not allowed. So let me recall those four important criteria which you guys have to remember. First, the expense should not be a capital receipt. Second, the expense should not be a personal expense. Third, the expense should not be outstanding or unpaid. Fourth criteria, reserves and provisions are not allowed as expenses. So with this, we will wind up today's class. If you guys have any questions, any doubts on the concepts what we have discussed, please don't hesitate. Please don't keep these concepts to yourself. One more point which I wanted to mention was